Singaporeans. What if I told you that you can now own China's biggest tech giants like Alibaba and JD.com right here on SGX and get paid dividends in Singapore dollars? That's right. No Hong Kong broker needed, no FX hassle, and yes, you can build real passive income from these tech titans starting today. In this video, I'll break down the business models, compare their latest financials, dividend yields, valuations, and by the end, you'll know which stock might be a better fit for your income portfolio. So stay till the end, smash the like button to help more Singaporeans discover this opportunity, and let's dive into the world of SDRs. Just a quick heads up. This video is for education and entertainment. It's not financial advice. Always do your own research before making investment decisions. Part 1. What is an SGX SDR? Alright, let's kick things off with the basics. What in the world is an SDR? SDR stands for Singapore Depository Receipt. Think of it as a shortcut or a bridge. Instead of jumping through hoops to open a foreign brokerage account in Hong Kong and wrestle with foreign exchange rates, SDRs let you buy major Hong Kong-listed stocks right here on SGX, using your usual Singapore brokerage. Yes, you heard that right. You can own global giants with just your SGX account. No overseas bank, no currency juggling. Best part? When these companies pay dividends, you get them in Singapore dollars. No FX charges, no paperwork, just clean, crisp SGD automatically credited to your account. That's music to any income investor's ears. Part 2. Meet the Hong Kong giants available as SDRs. So what Hong Kong stocks can you actually buy as SDRs in Singapore? As of today, the Singapore Exchange, or SGX, offers 11 Hong Kong-listed giants in SDR form. And they're not just any companies. These are some of China's biggest names across tech, finance, energy, and more. Let's take a quick tour of who's who. Alibaba Group, SGX, HBBD, the e-commerce and cloud titan. Imagine Amazon plus AWS, but Asian. Alibaba runs platforms like Taobao and Tmall and is a global force in online shopping and cloud infrastructure. JD.com, SGX HJDD, China's largest direct e-retailer. JD isn't just about online sales. They own the warehouses, drivers, and delivery vans too. Total Control, Amazon style. Ping An Insurance, SGX HPAD, one of China's top insurers, but with a digital twist. They're big in fintech, health tech, and even AI-driven diagnostics. Bank of China, SGX HBND, a banking behemoth backed by the Chinese government. They're everywhere, from Beijing to London, and now your Singapore portfolio. HSBC Holdings, SGX HSHD, a global bank with deep roots in Asia. While headquartered in the UK, HSBC makes most of its money in Hong Kong and China. Meituan, SGX HMTD, China's all-in-one super app. Food delivery, travel booking, movie tickets, you name it, Meituan does it. Xiaomi, SGX HXXD. Known for their budget-friendly smartphones, Xiaomi has expanded into smart homes, wearables, and even EVs. PetroChina, SGX HPCD, one of the world's largest oil and gas players. They manage everything from exploration to petrol pump. SMIC, SGX HSMD, Semiconductor Manufacturing International Corp., China's answer to TSMC. A rising chip-making giant in a geopolitically hot industry. BYD, SGX HYDD, the EV juggernaut backed by Warren Buffett. BYD isn't just making cars. They build their own batteries and dominate the China EV market. Tencent, SGX HTCD, gaming, fintech, social media. Tencent does it all. From WeChat to Honor of Kings, they're China's digital powerhouse. And remember, when you invest in these via SGX SDRs, your dividends come in Singapore dollars. No FX conversions, no overseas custody fees. Just easy access to China's biggest names right from your SGX account. Part 3. Why does this matter for Singapore investors? Why does this matter? Because you now have access to China's biggest and fastest growing companies. all while staying within SGX and getting paid in SGD. That means more diversification, more opportunities, and potentially more passive income. In this video, we're going to zoom in on two e-commerce heavyweights, Alibaba and JD.com. Which one is more profitable? Which pays better dividends? Which one has better long-term potential for your Singapore portfolio? Stick around. We're breaking it all down next, and you won't want to miss it. Part 4. What do Alibaba and JD.com actually do? Let's be honest. Both Alibaba and JD.com are massive e-commerce players in China. But the way they operate? It's like comparing CapitaLand to NTUC Fair Price. Same industry, totally different playbooks. Alibaba is like the CapitaLand of the internet. It doesn't own the shops, it owns them all. Platforms like Taobao, Tmall, and AliExpress act as giant virtual marketplaces. Sellers list, buyers shop. And Alibaba takes a cut via ads, transaction fees, and other services. It doesn't hold inventory or run warehouses. It simply connects people. Think of it as a tech landlord, like Shopee or eBay on steroids. In short, asset-light, platform business, super scalable with low capex. JD.com, on the other hand, is China's Amazon, and it's also a bit of NTUC and DHL. JD buys and stores inventory, from electronics to groceries. It operates its own warehouses and even its own last-mile delivery network. From checkout to doorstep, JD controls everything. That means faster delivery, better quality control, and a more trusted experience. In short, asset-heavy, retail-driven business, with tight logistics and high control. Let's summarize their business styles. Alibaba equals platform business. Connects buyers and sellers, doesn't touch the goods. Strengths, scalability, low capital expenditure, wide reach. JD.com equals retail plus logistics. Owns goods and delivery chain. Strengths, speed, reliability, full customer experience control. Coming up next, how do these differences show up in the numbers? Who's making more profit? Who pays better dividends? And what does it mean for income investors like us in Singapore? Stick around. This is where it gets exciting. Stick around, especially if you care about passive income and long-term growth. Part 5. Financial Performance. Latest Results. Let's take a quick look at how Alibaba and JD.com have been performing. Just note that they reported results for different time periods, so we won't do a direct apples-to-apples comparison. Alibaba, listed as SGX HBBD. For the 6 months ending 30th September 2024, Alibaba brought in renminbi 460.20 billion in revenue and earned renminbi 46.3 billion in net income, a strong net margin of around 10%. The platform business continues to generate healthy profits and strong cash flow, thanks to its scalable model and fast-growing cloud segment. JD.com, listed as SGX HJDD. For the full year ending 31st December 2024, JD.com reported renminbi 1.16 trillion in revenue and renminbi 41.4 billion in net income, a margin of about 3.6%, but notably higher than the year before. JD's focus on operational efficiency is paying off, and the company also returned cash to shareholders through dividends and share buybacks. Bottom line, both giants are profitable, cash flow rich, and rewarding shareholders, just with very different business models. Part 6. Valuation. Who's the better bargain? Let's talk numbers. Not just how much money they make, but how the market is pricing these giants. Alibaba has a market cap of Hong Kong dollars 2.15 trillion, making it one of the most valuable companies in Asia. Its current price-to-earnings ratio is 15.42, and the price-to-book or PB ratio stands at 1.92. That means investors are paying about 15 times earnings and nearly twice the book value for Alibaba shares. JD.com, on the other hand, has a much smaller market cap of Hong Kong dollars 366.6 billion. That's around 1/6 the size of Alibaba. Its price-to-earnings ratio is lower at just 7.85, and the price-to-book ratio is 1.41, which makes it look cheaper on paper. So yes, JD.com is trading at a discount. It's more value stock than growth rocket right now. But don't rush to conclusions. A lower price-to-earnings ratio doesn't automatically mean it's the better buy. Alibaba commands a premium because of its higher margins, stronger brand ecosystem, and powerful cloud and AI businesses. JD.com offers better control over logistics and customer experience, but it also bears higher costs. Are both stocks undervalued? Based on their recent earnings, strong balance sheets, and historical valuation ranges, yes, especially JD.com. For long-term income investors, these current levels could be attractive entry points. Coming up next, who's giving more dividends to Singapore investors, and what kind of cash flow you can expect? Part 7. Who's more generous? Alright, let's talk about something every income investor loves: dividends. So, between Alibaba and JD.com, who's actually putting more cash into your pocket? Well, JD.com is really shaping up as the steady and growing dividend machine here. Right now, JD.com offers a more attractive yield. It's about 3.2% based on the latest annual dividend. And what's even better is that the payout has been growing consistently year after year. In fact, the latest dividend was bumped up by over 30% compared to the previous year. That's a clear signal of JD.com's commitment to rewarding shareholders while still keeping things sustainable with a payout ratio of around 24%. For income-focused investors, that's definitely something to cheer about. Now, let's look at Alibaba. Yes, they do pay a dividend, but the yield is lower, around 1.7%. More importantly, the payout was actually trimmed compared to last year. While Alibaba is still profitable and keeps returning cash to shareholders, this move probably signals a more cautious approach for now, maybe to focus more on reinvestment or restructuring. That said, their payout ratio is still conservative at about 22%, so there's flexibility for future growth or even a dividend increase down the road. Both companies pay dividends once a year, and both are well within healthy payout limits, which means their dividends are sustainable. And here's the best part for Singapore investors. When you invest in these companies through SGX SDRs, your dividends are automatically paid in Singapore dollars. No currency headaches, no foreign conversion fees, just clean, simple passive income in your own currency. Part 8. What's next for Alibaba and JD.com? So let's take a peek into the crystal ball. Where are these tech giants headed next? Alibaba isn't just the Taobao or Tmall you know anymore. It's evolving fast, and in a pretty big way. Their cloud division, Alibaba Cloud, is scaling up aggressively, serving government agencies, banks, and businesses all across Asia. They're also expanding their data center footprint, including new infrastructure in Singapore and Korea, which is great news if you want exposure to Asia's digital backbone. Plus, they've invested in AI startups like Minimax, showing some serious ambition in the artificial intelligence space. Imagine a future where Alibaba becomes the AWS and ChatGPT of Asia. If you believe in the digital transformation of Asia, Alibaba is really positioning itself as a long-term tech infrastructure leader, way beyond just online shopping. Now, JD.com is not standing still either. They're pushing hard into new verticals. For example, they're ramping up food delivery, stepping into the same space as Meituan, and trying to grab a share in China's booming convenience economy. They're also building smarter, more efficient logistics and automation tech, which not only helps margins, but also gives them a real competitive moat. And get this, JD is even moving into travel services, so booking your next China vacation through JD might actually be a thing soon. JD.com isn't just a retailer anymore. It's transforming into a full-stack lifestyle and logistics platform, with strong control over everything from warehouses to last-mile delivery. What do analysts say? Both companies are still growing, even in a slower Chinese economy. Alibaba is projected to grow revenue by over 10% in the next quarter, mainly driven by cloud and international commerce. JD.com is expected to grow even faster, at 15% or more, thanks to its booming logistics and service arms. If you're a Singapore investor looking for long-term exposure to China's tech growth, these two SDRs might really be worth a closer look. One gives you scalable platform power with Alibaba. The other gives you end-to-end logistics muscle with JD.com. Both are innovating, expanding, and aiming to deliver real shareholder value. Part 9. Should Singapore income investors buy Alibaba or JD.com SDRs? Alright, decision time. If you're a Singapore investor looking for income and long-term growth, how do these two tech giants actually stack up? Let's break it down. If dividends are your thing, JD.com SDR might be the more attractive choice. With a higher dividend yield, around 3.2%, and strong dividend growth momentum, JD.com is clearly rewarding shareholders more, at least for now. But if long-term growth potential and margins matter more to you, then Alibaba SDR might appeal more. Despite a lower dividend yield, Alibaba runs a more profitable platform business with solid margins and some big bets in cloud computing and AI. Its tech pivot could really pay off big in the long run, and we're already seeing that through its heavy investment in future infrastructure. Or why not both? By holding both Alibaba and JD.com SDRs, you're getting exposure to two very different growth engines within China's digital economy. Alibaba is asset-light, scalable, and cloud-heavy. JD.com is asset-heavy, logistics-driven, and consistent with dividends. Together, they form a complementary combo, one focused on digital platforms and global expansion, the other on control, logistics, and reliability. And here's the real perk for Singapore investors. No foreign brokerage needed. No FX risk. Dividends come in SGD. And all tradable on SGX, just like DBS or Singtel. It's honestly one of the easiest and cleanest ways for Singaporeans to tap into China's tech rebound, without all the usual overseas hassle. So here's a quick recap. Want higher dividends now? Go with JD.com SDR. Want higher margins and future growth? Alibaba SDR is probably your pick. Want smart diversification and a smoother income journey? Maybe. Just go with both. Closing thoughts. So, are you Team Alibaba or Team JD.com? Or maybe you're smartly holding both for income and growth? If you learned something new today, or now see these tech giants in a different light, give this video a thumbs up. It really helps more Singaporeans discover practical ways to grow their wealth. And if you're serious about building a steady income portfolio right here in Singapore, subscribe to Wealth for You and hit that bell so you never miss another video that makes investing simple. Drop us a comment below. Which SDR would you invest in, and why? Let's grow smarter together as a community.